At 8:30 a.m. Eastern Standard Time on January 1st, 2026, the Shanghai Gold Exchange physical silver price opened at $77.50 per ounce, a staggering $5.50 premium over COMEX March futures trading calmly at $72. Dealer sites across Asia flashed out-of-stock notices on allocated bars as the licensing requirement for Chinese exporters officially took effect at midnight Beijing time. The Shanghai futures contract had gapped into violent backwardation overnight, with spot trading 320 above the February delivery contract, an inversion that screamed immediate scarcity. While Western screens showed orderly two-sided markets and stable bid-ask spreads, the physical reality told a different story. Major dealers in Singapore, Hong Kong, and Tokyo reported zero available inventory on serial-numbered 1,000-ounce bars, the industrial standard for global silver settlement. In the next 12 hours, the global silver market would face a perfect storm, and the effects could be catastrophic if you don't understand the difference between paper and physical now. By 9 a.m. China Standard Time on January 1st, the Ministry of Commerce licensing system went live, instantly blocking hundreds of smaller exporters who had supplied 60 to 70% of the world's refined silver for decades. COMEX March futures opened New York hours at $72.15, up just 15 cents, showing no panic, no violent gap, no recognition that the world's largest silver gatekeeper had just slammed the door. Dealers in London posted updates, delivery delayed 8 to 12 weeks, subject to availability. The observable data told the real story. Physical premiums in allocated metal jumped to 6% over spot within the first trading hour, double the normal range. Shanghai's HistoFund T+D spot contract settled the morning session at 19,400 yuan per kilogram, translating to 70 cent order 50 per ounce at the prevailing exchange rate, while New York futures hadn't budged. It's already happening, and the market hasn't yet woken up. By 11:45 a.m. Eastern on January 1st, the divergence between Shanghai physical and COMEX paper had widened to an unprecedented $3.50 per ounce, with Shanghai quoting $77.50 against COMEX's $74.06. The spread wasn't narrowing through arbitrage, it was expanding. Under normal conditions, when Shanghai trades at a premium, arbitrageurs ship metal from COMEX registered warehouses to China, collect the spread, and force prices back into alignment. But registered COMEX inventories had fallen 70% since 2020, dropping to barely 16 million ounces after a massive 13.4 million ounce transfer from registered to eligible vaults during Thanksgiving week. There wasn't enough deliverable metal to arbitrage the gap. The Shanghai spot to futures curve had inverted into full backwardation, with immediate delivery commanding a $2.80 premium over the February contract, a structure that signals traders prefer metal in hand today over promises for next month. Lease rates in London spiked to 38% annualized as bullion banks scrambled to borrow physical silver to meet obligations. This isn't normal. A supply shortage is beginning to tear apart paper and physical markets. By 1:30 p.m. Eastern, the supply chain impact rippled across 3 continents. Dealers in Germany posted notices. 1,000 Oz bars, sold out, no ETA. A major Swiss refiner updated its website. New orders 16 to 20 weeks, allocated stock only. Middle Eastern traders reported premiums of $7.50 per ounce for immediate delivery on kilobars, while spot settlement in Dubai showed $79.20, $5.20 above COMEX. The physical silver market was fracturing into regional silos as export restrictions choked the arteries of global supply. In India, where Diwali demand had already drained inventories in October, importers faced a stark reality. China's new licensing system meant no more spot shipments, no more just-in-time delivery, no more counting on Chinese refiners to fill sudden gaps. Serial-numbered stock, the traceable bars required for institutional delivery, had effectively vanished from dealer inventories. Premium charts showed 8.0 per ounce spreads on allocated silver, levels not seen since the Hunt brothers squeeze of 1980, but this time driven by industrial consumption and geopolitical supply walls, not speculative hoarding. It's not just futures. This is a real shortage, and no one can meet demand now. By 2:45 p.m. Eastern COMEX March, futures volume spiked to 85,000 contracts traded in 2 hours, more than double the normal afternoon pace, yet the price barely moved, oscillating between $73.80 and $74.30 in a tight range that suggested algorithmic suppression or coordinated short selling to keep the screen calm. But physical dealers told a different story entirely. A major New York bullion house posted an internal memo visible on dealer forums: physical silver unavailable at current futures prices. Bids wanted for allocated 1,000 Oz bars. The divergence was complete. Paper markets showed liquidity, two-sided quotes, orderly price discovery, while the physical market showed illiquidity vacuum, one-sided demand, and delivery failure. The mechanism of price discovery had broken. Normally, when futures rise, physical dealers unlock supply by raising premiums just enough to pull metal out of vaults or private holdings. But with Chinese export channels severed and COMEX registered inventories near decade lows, there was no supply to unlock. Shanghai's premium over COMEX held firm at $4.20 per ounce through the afternoon session, with no arbitrage flow, no convergence trade, no equilibrium mechanism functioning. This is where your paper positions risk becoming worthless when metal isn't available. At 3 p.m. Eastern, the arbitrage collapse became mathematically undeniable. The Shanghai COMEX spread had blown out to $4.50 per ounce, an impossible divergence under normal market conditions where arbitrageurs would instantly borrow metal in New York, ship it to China, deliver against Shanghai contracts, and pocket the spread. But lease rates in London had spiked to 40% annualized, the highest cost of borrowing physical silver in recorded history, making the arbitrage uneconomical even at a $4.50 spread. The math didn't work. Borrow 10,000 ounces in London at 40% annualized for 90 days, pay $1,000 in lease costs, add $800 in shipping and insurance to Shanghai, and the break-even spread became $1.80 per ounce. At $4.50, there should have been free money on the table, but there was no metal to borrow. The London Bullion Market Association vaults had lost 40% of their silver holdings since 2021, dropping to barely 30,000 metric tons, less than 45 days of global industrial consumption. Bullion banks couldn't lend what they didn't have. The arbitrage mechanism, the fundamental safety valve that keeps global markets aligned, had stopped functioning. You can't buy metal at these prices, and this is why the paper market is no longer reliable. By 4 p.m. Eastern, dealer inventories reached historically critical lows as the physical demand squeeze intensified. Shanghai's premium had widened further to a record 10.0 per ounce, with the physical spot price hitting $84, while COMEX futures traded at $74, a 13.5% gap that defied every textbook explanation of efficient markets. Major industrial buyers in the electronics and solar sectors, who normally purchased silver through forward contracts tied to COMEX pricing, suddenly faced a terrifying reality. Their suppliers couldn't deliver at contracted prices because physical metal wasn't available at COMEX quotes. Reports surfaced of solar manufacturers in Taiwan offering $8.0 premiums over spot for immediate delivery on 10,000-ounce lots, willing to pay $82 per ounce while the screen still showed $74. The disconnect between industrial reality and financial fantasy had never been wider. COMEX registered inventories stood at just 16.8 million ounces, barely 2 days of global industrial demand, while open interest in March futures represented potential delivery obligations of 75 million ounces. The leverage ratio was catastrophic. If even 10% of long contract holders stood for delivery, the exchange would face a shortage of 58 million ounces with no mechanism to source metal from China. This is no longer a paper market. We're seeing physical supply conditions deteriorate in real time. At 5:30 p.m. Eastern, COMEX delivery notices for January settlement spiked to 4,200 contracts, representing 21 million ounces of silver that would need to be physically delivered in the next 4 weeks. Under normal conditions, this would be manageable, but conditions weren't normal. Registered inventories sat at 16.8 million ounces, creating an immediate shortfall of 4.2 million ounces if all notices stood for delivery. The exchange rules allowed for cash settlement if both parties agreed, but long holders demanding physical couldn't be forced to accept paper. The gamma pressure was building. As delivery month approached, the spread between March futures and spot would normally converge to zero, but with Shanghai trading $10 over COMEX and physical premiums exploding, convergence meant COMEX futures had to gap higher or the exchange faced delivery default. Dealers monitoring the situation posted warnings. Delivery risk elevated. Physical settlement may require 40-60-day delays. Industrial shorts who had sold futures to hedge production suddenly faced a nightmare scenario. They might need to deliver metal they couldn't source at prices that no longer reflected physical reality. The choice was binary: scramble to source physical silver at $10 premiums and deliver at a loss, or negotiate cash settlement at spot prices that bore no relation to what metal actually traded for. You'll need to deliver metal or cash settle at a loss. There's no in-between. By 6 p.m. Eastern, the geopolitical dimension came into sharp focus as analysts connected China's silver export restrictions to a broader pattern of resource nationalism and currency war maneuvering. On December 26th, just 5 days before the licensing system took effect, China had revised its export control law to take effect March 1st, 2026, providing an even stronger legal framework for the government to restrict outflows of strategic materials. Silver was now explicitly classified as a critical mineral alongside rare earths, antimony, and tungsten, all metals essential for green energy, military electronics, and advanced manufacturing. The timing wasn't coincidental. As the U.S. Federal Reserve signaled further rate cuts into 2026 and the dollar weakened against major currencies, hard assets like silver surged. Central banks had purchased over 800 tons of gold in 2025, the highest annual demand since the post-World War II Bretton Woods era, signaling a global shift away from dollar reserves toward tangible stores of value. China's move to restrict silver exports, while domestic solar panel production consumed 20% of global silver supply, wasn't just about market dynamics. It was about locking strategic resources inside national borders during a period of currency instability and trade fragmentation. This isn't just a silver market problem, this is systemic. At 7:40 p.m. Eastern, the structural squeeze became mathematically inevitable as production versus demand misalignment forced silver into severe scarcity. Global silver production had stagnated at 820 million ounces annually, while demand had surged to 1.24 billion ounces, a deficit of 420 million ounces per year. Over 5 consecutive years, the cumulative shortfall had reached 800 million ounces, nearly an entire year of global production, drained from above-ground stockpiles. The deficit wasn't speculative theory, it was observable fact. COMEX registered inventories down 70% since 2020. London Bullion Market Association vaults down 40% since 2021. Shanghai Futures Exchange warehouses at 10-year lows. The metal was disappearing into industrial consumption, solar panels, electric vehicle batteries, smartphone electronics, 5G infrastructure, and it wasn't coming back. Unlike gold, which largely sits in vaults and recirculates, 60% of silver gets consumed in manufacturing processes where recovery is uneconomical. Even more critically, 75% of silver production came as a byproduct of copper, zinc, and lead mining, meaning supply couldn't respond to higher prices unless base metal economics justified new mine development, a process requiring 8 to 12 years from discovery to production. The math was inevitable. Production cannot meet demand. By 8:00 p.m. Eastern, key price movement markers signaled the market was entering forced repricing conditions. Shanghai physical silver closed the session at $85 per ounce, a full $11 premium over COMEX March futures at $74. The widest gap in recorded history between Asia's primary physical delivery market and the Western paper benchmark. The 15% divergence couldn't persist indefinitely without triggering one of two outcomes. Either COMEX futures would gap higher to meet physical reality, stressing every derivatives book, swap position, and under-collateralized contract tied to the old price, or the paper market would lose all credibility as the global pricing mechanism, with buyers simply abandoning Western futures and following Shanghai's physical price. Spot premiums on allocated 1,000-ounce bars had reached $15 per ounce across Asian trading hubs, with dealers in Singapore quoting $89 for immediate settlement while New York screens still showed $74. Industrial buyers no longer trusted COMEX quotes. They were pricing contracts based on Shanghai physical plus freight, effectively writing off Western futures as irrelevant to real-world transactions. The lease rate spiked to 40% annualized, and backwardation depth of $3.50 between spot and February futures confirmed a market under violent stress where normal equilibrium mechanisms had ceased to function. You're about to see a repricing explosion, but only if you're paying attention. At 9:00 p.m. Eastern, the personal risk scenario crystallized for individual investors and retail buyers holding paper silver exposure through ETFs, unallocated accounts, or futures contracts. The Shanghai premium over COMEX had settled at $10 per ounce, meaning if physical settlement became necessary, paper holders faced a brutal reality. The price they thought they owned silver at bore no relation to the price they'd need to pay to actually acquire metal. Unallocated accounts at major banks carried explicit disclaimers buried in contract fine print. Physical delivery not guaranteed, cash settlement at prevailing spot price. But which spot price? COMEX at $74 or Shanghai physical at $84. If the bank settled at COMEX quotes while real metal traded $10 higher, account holders absorbed a 13% loss instantly. Silver ETFs like SLV, which held 550 million ounces and claimed to be backed by physical silver, faced growing scrutiny. If 5% of shareholders demanded redemption in physical form, the ETF would need to source 27.5 million ounces from a market where dealers had zero available inventory and COMEX registered vaults held only 16.8 million. The math didn't add up. Retail buyers scrambling to convert paper to physical faced premiums of $15 per ounce on coins, $12 on bars, and delivery delays of 12 to 20 weeks. If dealers would even accept new orders, you're either positioned for a squeeze or you're trapped. By 10:00 p.m. Eastern, key event windows for potential catalysts came into focus as traders mapped the next 48 hours. January 2nd would bring the first full trading day under China's licensing regime, with industrial buyers in Asia scrambling to source alternatives and potentially driving Shanghai premiums even wider. The London Bullion Market Association's morning fixing at 10:30 a.m. GMT on January 2nd would provide the first global benchmark under the new supply reality. If London fixed $5 or more above COMEX, it would confirm the paper market's irrelevance. COMEX margin requirements for silver futures were under review after the CME Group raised initial margins by 13.6% on December 26th in response to violent volatility. If margins rose again, it would force leveraged longs to either post more cash or liquidate, potentially triggering a cascade of selling in paper markets, even as physical markets tightened further. Geopolitical wildcards loomed. U.S. response to China's export restrictions, potential European Union trade retaliation, emergency consultations among G7 industrial nations facing silver supply disruptions. Production constraints offered no near-term relief. The world's largest silver mine in Mexico was operating at capacity. Australian and Peruvian production was flat, and no major new projects were scheduled to come online before 2028. What happens next depends on your actions right now. At 11 Aus p.m. Eastern on January 1st, 2026, the physical premium remained locked at 10 pondur per ounce, with Shanghai settling at 84 dollars and COMEX futures closing the overnight session at 74,000. The $10 gap was not a temporary dislocation. It was a new structural reality reflecting the severed connection between Western paper markets and Asian physical supply. Backwardation in Shanghai had deepened, with spot now trading $3.80 above the February contract and $6.50 above April, an inverted curve that signaled immediate demand overwhelming forward supply. COMEX registered inventories remained at 16.8 million ounces, effectively unchanged from the morning count, while eligible inventories, metal sitting in warehouses but not designated for futures delivery, stood at 196 million ounces, most of which belonged to private holders unwilling to convert to registered at current prices. The arbitrage between COMEX and Shanghai that should have closed the gap showed no signs of functioning. Lease rates remained pinned at 38 to 40% annualized, bullion banks remained unable to source borrowable metal, and freight capacity from New York to Shanghai remained unutilized because there was no metal to ship. Industrial buyers in electronics, solar, and automotive manufacturing faced the stark choice. Pay Shanghai physical prices immediately or face production shutdowns within 60 days as existing inventories depleted. The global squeeze continues to build. Here's the proof. The spread that opened at $5.50 per ounce between Shanghai and COMEX at 8:30 a.m. Eastern closed at 10 pondur by midnight, a doubling of the divergence in under 16 hours. Shanghai premium over COMEX futures, locked above $10 per ounce, an irreducible gap with no resolution mechanism in sight. COMEX registered inventories 16.8 million ounces, covering barely 2 days of global industrial demand. Shanghai Futures Exchange inventories, multi-year lows with withdrawals accelerating. Available arbitrage between COMEX and Shanghai at current levels, zero. The system that was supposed to keep global prices aligned through arbitrage never showed up.